So let's talk about, we've got our generation, some of them have got property, some are looking to get property, but it's quite overwhelming. The prices are very high. What are your suggestions for new time investors in the property market?
Sure. Well, I think one of the big things that's come out over the last year is the rent vesting concept. And the rent vesting concept is most people can't afford to buy where they want to have a home. And even me, I still can't afford it. And so the concept is rent the home wherever you want to live, the emotional place, and then invest where you get the highest return. Mm-hmm. So say if we talk about Sydney or Melbourne, a 20-year-old can't afford a beachfront property in Bondi or down at St Kilda or Prahran or wherever they want to live. Mm-hmm. So the whole idea is like a monopoly thing, is buy lots of those little green houses, and those green houses are effectively units in Sydney or Melbourne or a house somewhere else, and then go and rent the house or the hotel in Mayfair or Park Lane.
Definitely. And there's a lot of other positives with that. Like we have a similar philosophy here, and we talk about that every day something breaks in the house and you're having to, when you own it yourself, you have to fix it and you want to improve it. And you also go, oh, I don't really like those blinds. Let's go spend a few $1,000s on that. And I feel like it's a sort of like a bottomless money pit.
It is.
Yeah.
So suddenly there's no emotion about all those kind of things going wrong. So look, whether you're into property or you're into shares or you're into kind of bonds or whatever, it doesn't matter. You've just got to do something, because if nothing changes, nothing changes.
Yeah.
And you're never going to save your way, because property prices increase so much. If we get that 10% growth, 500 grand property, that's 50 grand. How many young people are going to save 50 grand? So whether you get into 100 grand one or two or 500, and another thing we're looking at next year is this fractional ownership thing, mm-hmm. which is a big change. And so the concept behind this is, if you had $1 million, you'd never put $1 million into a single share. So why would you put it into a single property? And the thought process is here is, you could buy $1 million Bondi unit, but if you've only got 50 grand or 25 or even $5,000, is put your money into that, and then maybe half it into shares or whatever your ratio are, versus having, say, 50 grand of a 50 grand property that's 1,000 miles from anywhere.
Definitely. And it just goes back to one of our most important parts of investment strategy is diversification. And I'm really excited about the opportunities there. I think Chris just said an absolute perler just before about investing. You just got to do it. Not investing is not an option. It's something we actually have in the start of our investment philosophy. It's just like, you've just got to start building wealth and focus on the long term rather than just short-term gains.
It was funny, I was in Aspen last night and speaking to a friend of a friend, a young girl, she's 28, and she bought a property in Wallara mm-hmm. for 500 grand, and now she's kind of taking a year off. And I said, what's it worth now? And she said 700, so she made 200 grand. And I said, yeah, but just imagine if you bought 5 of them, mm-hmm. you'd have made $1 million. So she's seen it. So she maybe bought it 3 or 4 years ago. She's made a bit of money, but it's taking that next step to say, you're never going to save that. No matter what job you do, you're never going to save 200 grand. You need to try and get a job as a means to an end, even if it's for 3 or 4 months, to get the mortgage, to get the equity out, to then buy that next one. And whether it's 500 grand, $1 million, doesn't matter. You've still made 200 grand.
Definitely.
But you've got to follow the success. McDonald's, it's just turning that wheel. If you do something well, just keep repeating. You don't need to find the latest, greatest.
And it's something we always see when people, we have a lot of Wealth Enhancers members who are now millionaires, effectively. And they start feeling they've got a lot more money. They need to complicate their strategy because they're like, well, I've got more money now. I need to be doing more exciting, sexy things. And it's not the case. Investing is it's a simple strategy. Just keep with it. And once you get a bit more money, you have more options available to you. But the strategy pretty much stays the same. Like, you haven't changed for 20 years, have you?
No, I keep looking at different things because I was always said, like, punt 5 or 10% on different strategies. So I tried a house and land. I tried off the plan. Wasn't my kind of thing. Mm-hmm. And so I say to a lot of people is my strategy is too simple for most clever people, because I've just been at a conference, 350 accountants and lawyers, and some of them are fund managers and stuff like that. They're making, or they're around like millions or billions of dollars. And you look at the research they do and they analyze 2,000 companies. Like, I just go buy another property.
Yeah.
And then you sit on the beach and you wait another year and it's gone up. And if it hasn't, you wait another year.